Hey everyone, it's Daniel here from Here For Us. Hope you're all doing well. Let's talk about this article that came out. It's a couple days old article. It's about a trader that put on a bet of about $18 million, betting that the Fed would go to 6% in interest rates by the time we hit September. Now, if that trade works out, this trader would make $135 million and would be probably very happy if that happens, right? Now, you got to be a little bit careful with news and trades and the media hyping up certain traders, because there could be many reasons behind why this trader is doing this. It could be a hedge. That amount of money could be very minuscule to him. Portfolio may be managing way bigger in the billions, maybe, right? But wanting to put some sort of hedge or a bet that, we could see that Fed goes to 6%. Now, being CPI day, I don't know when you're watching this video. Maybe you're watching it post CPI, pre-CPI. So this video is coming out actually pre-CPI. But it's very important to bring this article back in, because CPI is going to be very crucial in the next coming months. Not only this report will bring in a shock to the markets. I don't know which way, because this is a video pre-CPI. But definitely this CPI and the next coming CPI, especially because there's been a change in the data on how they're calculating it, right? Previously, we had CPI being calculated for 2 years average. Now we're getting 1 year average and calculating the CPI based on that. So definitely we're going to see drastic changes in the number, which could bring possibly more volatility in the markets as well. Now, what's going to be very crucial, right, for the markets, for this trader that's betting on the 6%, is that if inflation is not coming down and it continues to be sticky, and the data continues to be resilient, and the data in the jobs data specifically is very strong, then it will cause the Fed to continue pressing on the brakes even harder than what we've seen in 2022. And I wouldn't be shocked, to be honest, and I did a video on this previously talking about interest rates possibly hitting 6%. But I wouldn't be shocked to see interest rates hitting 6%, because if we bring back the Taylor rule and what Bullard said in his previous lecture that he had, his speech that he did previously, he has a full slide deck talking about the Taylor rule, saying that in order to bring inflation down, the likely scenario path would be to follow the Taylor rule. And if you look at the Taylor rule basically tells us that we need to see rates above inflation. And if you look at previous inflation scenarios, in order for inflation to come down, we've seen previously interest rates go above the inflation level. So I would not be shocked if we saw rates go to 6% or even higher to bring this inflation level, especially if spending or the economy or jobs is still very strong. And the Fed has told us, and if you look at history, at the unemployment rate, every single time the unemployment rate goes into very low territory, we're talking about below 4%, hitting around 3%, 3 point something, and we saw that in the last jobs report, where the unemployment rate was sitting around 3 point something. I forgot the exact number, but it was around 3.5, 3.6, maybe 3.4. You can pull it up, check it out, the last data point. But that number signals, if you look back in history, every time we get to very extreme low levels of unemployment, we've seen over and over and over time in history that after a very low unemployment rate follows a recession and a massive spike up in the unemployment rate, right? A massive spike up in an unemployment rate obviously tells you that, okay, recession, and we do get a recession that happens right after when we see the unemployment rate very low. So we see that right now. And if we look back in history of previous unemployment rate levels, previous interest rate levels versus the inflation, we've seen this time over time that it does eventually spike, and the Fed does want to see that number spike up. And we've seen it in the Fed's projections. They came out and told us this. In the FOMC meetings, when they released their projections, they said that they expect the unemployment rate to move up about 100 basis points. So about 1% higher, which basically is signaling to you that, yeah, unemployment rate is expected to spike. And for that number to spike, even though they didn't write that it's going to spike up 5, 6, 7%. They don't want to do that to shock the markets, right? So they will probably say something a little bit more subtle, but it's not really a subtle number, but it's something to very much note, is that if they're predicting the number to go up and they want job losses to happen, in order for that to happen, there has to be a recession, not this mild recession, not the soft landing. There's got to be an actual recession like we've seen in 2008, 2000, and previously. And how do you get that? You create pain, like the Fed has told us in August during Jackson Hole event. He said, bringing down inflation, raising rates is the unfortunate cost. Raising rates is the unfortunate cost to households and businesses because, hey, we have to do our job. We have to bring down inflation. And sorry, you're going to see people be affected heavily by this, and also businesses as well. So it'll be very interesting to see what CPI comes out today and what the projections will be in the next FOMC meeting, what the Fed members will come out to say, and most importantly, if this trader is right about 6% or maybe even higher, and see how that pans out, especially by the time we hit September. And I think it's a very much likelihood scenario, especially we're still in February right now. You're going to have to wait for some time to see the true effects of all the tightening we did in 2022, because there's a lag. And then on top of that, if you got the Fed increasing way more, and if the markets, the economy ends up being pretty bad in, let's say, September or before that, like this trader is expecting, and if we do get to 6% by September, imagine what next year, 2024, will look like if this year ends up being very ugly from the tightening we've done last year. And if that's the case, then we could see very, very, very bad numbers for the economy, for GDP, unemployment rate, and so on. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, and the bell icon to be notified on the next video. And I'll see you guys around. Cheers. Bye.